ericmuadatmuadat.com. This is going to be part 2 of this video here, and we're going to be taking a look at the question where I was posing the question, is gold really a safe haven asset? And as we saw in part 1, there's no evidence as far as I can tell. So what I'm going to do, I'm going to take a look at this from the 1980s and see what we can learn from the study and comparison of the market performance, being the S&P 500 and the gold index. So here we have all data going back to 1980. And one thing I wanted to do is make sure that I take a closer look at what happened in 1987 when the market crashed. And then again, there was another huge drop in 1998 here. Let's see what gold was doing, because if gold responded by moving higher when the market was crashing, then that makes sense. But what I'm going to do now is let's take a look at what happened in the 1980s. So what we have here is gold from 1980 to the beginning of 1990. And we can see here, generally speaking, that gold was moving higher here. So was the S&P 500. And gold drifted lower from 1981 to, let's call it about 82, and so did the general market. The general market recovers, and so does gold. Market pulls back, and so does gold. In fact, gold even drops more than the market. Right, so we can see that was divergence. The market starts recovering here. Gold goes lower. So underperforming the market. And then there's a period here where the market starts moving higher after a pullback. In fact, we can even do it that way. So does gold. Now, of course, we want to take a look at what happened in the market during the crash of 1987 here. So the market drops significantly in terms of percentage. And in terms of percentage, we can see that gold is sideways. Right here. You would expect during this time period that gold to be taking off. But no, gold is sideways during that 1987 crash. What is interesting, the market recovers and starts going higher, but take a look at gold. In fact, we can see the general market breaking out to all-time highs during that time period, as gold was struggling, making fresh lows. Which, frankly, is not very encouraging for gold, right? And if we take one more look at this period here, which was the crash of 1987, one might say that gold did not crash. And if that's the case, then okay, that's fine. Did not crash. But neither were you making any gains. In fact, take a look at this. I'm going to show you just one gold stock. So instead of comparing the market with gold, let's take a look at one gold stock, which is AEM. And here we can see that as the market crashed in 1987, so so did the stock. So pretty much if you are owning gold stocks, the market crashes, you crash with the market. So gold stocks are definitely not a safe haven. They are not. This is self-evident right here. And in fact, if you take a look here, we have a good period when the market was trending higher, and so was the stock itself. So seems to me that gold stocks generally tend to move higher when the market is stable to bullish. And then we see this interesting divergence, which doesn't speak well for gold, where the market goes higher and gold stocks drift lower. Now let's compare the gold index with the S&P 500, and this is now from 1990 to, let's call it, about 2001. So the 90s pretty much. Now what is interesting is if you go back to a time period where the beginning of Gulf War I here, the market starts moving higher. So that's the beginning of the Gulf War. Market trends higher. But take a look at gold. Loses ground. We can see here 94, sideways market for the S&P 500, sideways market for gold. S&P 500 starts a major bull market in 95 or thereabouts. Gold is sideways. Market continues higher. Gold is down. Seems to me that gold is a perennial underperformer. Market continues higher. Gold continues lower. In fact, substantially lower. And then comes the big question. What did gold do during this minor crash in the market in 1998? Which should have been giving gold investors some safety net. Well, take a look at this. So the same time period is right here. And we can see that the market dropped, sharp move here, and so did gold. No safe haven at all. And market recovers, and gold recovers slightly. General market goes higher, gold goes lower, substantially lower. Market is making a move to fresh highs here. Gold is making a move to fresh lows. That's a serious divergence. And then interestingly enough, we can see that the general market tops out in 2000 here, rolls over. Guess what? Gold does the same thing. Now that has been an exercise in just following the market, no opinions, just looking at the charts. And personally, I cannot escape the conclusion that gold is not a safe haven. It's not there on the charts. Maybe it will be a safe haven tomorrow, but not over the last 38 years. No sir, no way. No ma'am, no. Now, in fairness to gold, if we take a look at this chart here, which is from 2000 to, let's call it, about 2010, in fairness to gold, there is a period here when the market was in a bear market, of course, from 2000 to 2003. This period here. In fact, gold was more stable in 2001. And we can even say up to somewhere there in early 2002. So in fairness to gold, we can see here that this period and this period, gold was outperforming the market, generally speaking. And then both of them start moving higher. But notice, gold was just stable. There was no major move higher, no major move higher. It's only when the market bottoms here and starts moving higher that gold also picks up momentum. But the biggest, strongest move is here, which happened also as we established with an upward trending market. So in fairness to gold, I would say, in my opinion, over the last 38 years, gold did better than the market over a period of time here where it was stable in 2001, early 2002. But that's it. And maybe also in fairness to gold, you can see that gold bottomed here in 2008 before the market did. So gold did bottom before the market, because the market would bottom, let's say, another 5 months later, which is here. So in fairness to gold, maybe that was, it stopped going down before the market. But is that really a safe haven? I'm not sure. I'm not sure, to be honest. Seems to me that if you take a look at gold, and this is now back to the long-term monthly chart from 1980, seems to me that the people making money are the institutions that are pushing the agenda that investors need to use gold as a play if the market was to implode. In other words, the people making money, to be honest, is the people making commissions throughout this process. Millions, if not billions, of trades were made during this period with the idea that you need to have some gold in case the market implodes, because gold might outperform. But the only time gold has seen a major run, the market itself was also moving higher. So, you know, somebody is benefiting from the concept of gold being a safe haven, and it's not the people owning gold. It's the people who are making the money from the commissions. Now, I want to conclude this video by taking a look at what has happened over the last couple of weeks. And in conclusion, take note of what has happened. Of course, the gold color is for GLD, and the dark color is for SPX, S&P 500. Just want you to take note of what has happened over the last 2 weeks or so. Down for the market, down for GLD. And there you have it. This concludes part 2 of 2. Remember, for this video to make sense, make sure you've watched part 1 of 2. Eric Mwadhi with Mwadhi.com. As always, good luck, peace, and blessings. ERCS.